Hello friends, today we are going to see the topic Reserve Bank of India. Reserve Bank of India is a central bank for India. Worldwide, every country is having a central bank of its own. US have US Federal Reserve. In France, it is Bank of France. In Japan, it is Bank of Japan. In China, it is People's Bank of China. In Australia, it is Reserve Bank of Australia. Every country, because the politico-socio-economic factors differs from country to country, to suit their needs, they made some fine-tuning, but every country should have a central bank. Okay, what do you mean by central bank? In the last session also we have seen that central bank is a monetary authority for any country. So here in India we have Reserve Bank as the central bank. Okay, so they are the monetary authority for India. Okay, they are the monopoly authority for the note issue. Note issue means currency note issue. And they are the advisors to the government. They act as a custodian for foreign exchange reserves, and they control the credit. Okay, so these are all the general functions of a central bank. So let us see that in detail. Okay, first, formation of Reserve Bank of India, when it was formed. So for that we have to go back into history. Britishers came into India, established East India Company. They started doing business. Any business requires banking service, so they established 3 banks. In 1806, Bank of Calcutta, renamed as Bank of Bengal in 1809. Bank of Bengal. Then 1840, Bank of Bombay. Then 1843, Bank of Madras. These 3 banks are called presidency banks. The Britishers, they came here for traders, but exploiting the situation, they became rulers. They formed the government. Any government requires a central bank. So what they did is, they merged these 3 banks into Imperial Bank of India in 1921. They merged these 3 banks into Imperial Bank of India. Then it was supposed to act as a central bank for the British government, but it was not fulfilling its expectations. So they appointed a commission called Hilton Young Commission. 1926, Hilton Young Commission. Was appointed to go into the problem. Also in 1925, Dr. Ambedkar also has conceptualized the concept of a central bank, and he has given a report that was also taken into account. And Based on these recommendations of Hiltonian Commission, RBI Act was passed in 1934. And RBI started functioning from 1/4/1935. RBI started function from 1/4/1935. And it was nationalized on 1/1/1949. It was nationalized on 1/1/1949. So that is the genesis of Reserve Bank of India. Please take note of it. Initially, the head office, when it was formed, the head office was in Calcutta, and it was moved to Mumbai in 1937. And it was expected to announce its monetary policy every year in April. And there will be 3 quarterly reviews after the monetary policy in July, October, and January. So it will be monetary policy once in a year and quarterly reviews, 3 quarterly reviews. They review the economy and advise the government regarding what is happening. So this is their essentially their duty. Okay. Now let us please note it. We will go to the next organization. Reserve Bank of India, when it was started with a capital of 5 crores. Each share rupees 100. And 4 crore 97 lakhs 80,000 was with private hands. Only 2 lakhs 20,000 was in government hands. Total ₹5 crores. So it was started as a private bank. Private shareholders were the majority. So because of that, government encountered some problems. They are not able to implement their policy. So it was nationalized on 1/1/1949. Government took full control of the bank on 1/1/1949. Okay. It is controlled by central board. Headed by governor, deputy governors 4, then directors representing the local boards, four directors appointed by the government representing various sections of the society, industry, 10. Then government representative, two. Total 21. One governor, 4 deputy governors, directors representing local board 4, directors appointed by the government 10, then government representative usually from finance ministry, department of economic affairs and department of financial affairs, 2 officers. So total 21. And it meets at least 6 times in a year. It has to meet at least 6 times in a year. That means at least once in 2 months. That is central board. Because the head office is in Bombay, it meets in Mumbai. Then local boards. Four, New Delhi for the western region, then Mumbai, then Calcutta and Chennai. 4 local boards headed by manager in charge. They deal with the local issues, problems, something peculiar to the particular area. For example, floods in Kerala, that local board will be looking after that. Okay, this kind of regional issues, problems, they will be looking into, manager in charge. So 4 local boards. Then regional offices, (22). Regional offices 22. And they had training establishment also. RBI Staff College, Chennai, College of Agricultural, Banking, Pune, Bankers Training College in Mumbai, There are some more facilities for training. For example, NIBM, National Institute of Bank Management. So it trains bank officers in various aspects of banking. The first governor of Reserve Bank of India is Sir Osborne Smith, and the second one is Sir James Taylor. The third one is an Indian governor. He is the first Indian governor, Sir C.D. Deshmukh. Okay. So these are all the prominent governors in the initial stages who guided the Reserve Bank of India. RBI follows minimum reserve system. See, each country follows its own system. For US, they follow proportional reserve system. Here in India, we follow minimum reserve system. According to the RBI Act, we have to maintain a reserve of 200 crores, of which 115 crores will be in gold and 85 crores securities. Total 200 crores. It's minimum reserve system. There are some subsidiaries for Reserve Bank of India. DICGC, Deposit Insurance and Credit Guarantee Corporation, and RBIT. Reserve Bank Information Technology, Private Limited. These are all some of the subsidiaries. Okay. So we have seen introduction to central banking, formation of RBI, and organization. Okay. Let's move to the next topic. Functions of Reserve Bank of India. What are all the functions of Reserve Bank of India? The first function is currency issue. We call it note issue. So now we have seen the origin of Reserve Bank of India, its organization. Now we are going to see the functions of Reserve Bank of India. First one is currency issue. It's also called a note issue. It's also called a note issue. RBI is the only authority who can issue notes. Notes here means currency notes in the denomination of 2, 5, 10, 20, 50, 100, 200, 500 and 2000. So RBI can issue currency notes up to denomination 10,000. Previously 10,000 currency note was there. Now it was demonetized long back. And rupees 1 note and coins are minted in by the Government of India. You will see the difference in all currency notes. You will see the signature of RBI Governor, but in 1 rupee note you will see the signature of the Finance Secretary, Government of India. Okay. Even though government means the coins and 1 rupee and prints the 1 rupee note, it is distributed by RBI. It is distributed by RBI. Plastic currency also has been recently introduced in India. Rupees 10 denomination, only in one district. In West Bengal. RBI is studying the feedback and they will issue plastic currencies in various denominations, initially in 4 cities, big cities, and study the acceptance by the people, then it will introduce pan-India. Okay, note issue. It is under section 22 of the RBI Act. Section 22 of the RBI Act. They are authorized to issue currency notes. Then they are bankers to the government. Okay. Second function, bankers to the government. So, on behalf of state and central government, they accept receipts, make payments, and arrange remittances. So on behalf of state, they are bankers to the government. On behalf of state and central government, they accept receipts, make payments, and arrange remittances. They collect tax also. Please note down. They manage public debt. Government borrows from the public, no? By issuing treasury bills. and bonds. So they manage public debt. The office which is looking after this is called the PDO, Public Debt Office. They provide ways and means advance, that is ways and means advance. It is a kind of OD, overdraft, to state and central governments. Advises government, both state and central, in financial matters. And they represent the government in world bodies like IMF and World Bank. They represent the government in IMF and World Bank. Okay, so they are bankers to the government. Okay, then they are the regulatory authority of banks. Third one, regulatory authority of banks. Under that, they issue licenses to start a new bank and they give permission to open branches under branch authorization policy. So even for an old bank to start a new branch, they have to get permission under branch authorization policy. They audit various bank branches, conduct inspection, on various banks. So this comes under the regulatory authority of banks. Then they are the lender of the last resort. What do you mean by that? All banks depend on Reserve Bank of India. In times of crisis. Very recently, Lakshmi Bank, they encountered some problems. So RBI arranged DBS, a Singapore bank, to bail out this Lakshmi Bank. So likewise, various banks, they encounter various problems at various times. So at such times, it is the Reserve Bank of India who steps in and save the situation for the banks. Then clearinghouse operations. See, among banks, various transactions are taking place. See, a person gives a check to his bank and the check is drawn on some other bank and this bank collects the check from that bank. Likewise, so many transactions involving two and more banks are happening in the banks, and in such time, it is the Reserve Bank of India who clears all these checks and other instruments and transactions. They act as a settlement bank. Okay. Mutual indebtedness. Of various banks are settled in Reserve Bank of India. Say Canara Bank sends a NEFT or RTGS to State Bank of India. So State Bank of India pays that. So how to recover the amount from Canara Bank? So it is the Reserve Bank of India who acts as a settlement bank. Likewise, in case of checks, the checks are cleared through the clearinghouse. RBI is in charge for the clearinghouse. So clearinghouse operations, settlements between various banks that mutual indebtedness are settled in Reserve Bank of India. Okay. Okay. Next, foreign exchange operations. Reserve Bank of India is given the authority to maintain the value of the rupee. Value of the rupee is maintained by various forces, demand and supply forces, technical factors, politico, socio-economic factors, so many factors. So the value of the rupee is constantly in change in relation to various currencies. RBI is put in charge to maintain the value of the rupee. It does this function by buying and selling foreign currencies in various markets. For example, if too much of US dollars is coming into India, it buys them because it will affect the value of the rupee. If too much of dollars is going out of India, it sells. So it tries to maintain a balance between demand and supply for a particular currency because a value of the rupee is linked to a basket of various currencies, mainly US dollars, UK pounds, euros, French francs, Swedish kronas. So any variations in the value of those currencies will reflect on the value of the Indian rupee. And if Indian rupee value is too much affected, exporters and importers are affected. So RBI is entrusted with the duty to maintain the value of the rupee. That is, for that it does foreign exchange operations, buying, இல்லையா நான் அதை தானே அனுப்பினேன். ஓகே. So foreign exchange operations, it buys and sells foreign currencies. In various international markets. Foreign exchange market is worldwide, and major markets are New York, Zurich, Paris, Dubai. Okay. So it buys and sells. Sometimes for profit also it buys and sells. So it buys and sells foreign currency in various international markets. The main focus is to maintain the value of the rupee. And it controls inflow and outflow of foreign currencies into India. Inflow and outflow of foreign currencies. Whether they are bona fide transactions, whether they are legal or any illegality is there, it maintains a watch. Formerly, FERA was there, Foreign Exchange Regulation Act. That has been scrapped, and now FEMA, Foreign Exchange Management Act, 1999. A very strict law, so it is being enforced, and RBI, with the help of ED, Enforcement Directorate, it monitors the inflow and outflow of foreign currencies, whether they are legal bona fide transactions or is there any illegality is there. Then collection of data, research and publication. See, in economics, information is money. So, Reserve Bank of India collects data. All banks are supposed to submit returns. The various returns are there, R1, R2, R3, like that. So sub returns to be submitted on every Friday, on a weekly basis, some on daily basis, some on fortnightly basis, some on monthly basis, and some on quarterly basis, some on half-yearly basis, some on annual basis. All these reports are nothing but statements of facts. The record of transactions, what has taken place in the branches. So RBI collects all this data, consolidates them, and do research. How much currencies are come in, how much remittances gone out, how much agricultural loans are given, how much education loans are given. All this they do research and they publish reports. They have a publication division in Reserve Bank of India. And they do this publication. And they have a development function also. development function means commercial banks are providing loans to small and medium enterprises, but large corporates for large projects, specialized nature of projects, it requires finance in a large amount. For that commercial banks, they cannot do that. For that RBI promotes, for example, NABARD. National Bank for Agriculture and Rural Development to promote agriculture. Then National Housing Bank to promote housing. They provide finance to housing finance companies. Then Exim Bank to importers and exporters. Please note down. So these are all development functions. Then there are bankers' bank. All banks are supposed to open account with the Reserve Bank of India. So transactions involving clearing and other remittances are being settled through this account. CRR, cash reserve ratio, they have to maintain. So all banks should have account, usually current account with Reserve Bank of India. The next one is credit control function. Okay. Why credit should be controlled? Because if too much of money supply is there, inflation will increase. If there is shortage of money, there will be deflation. Okay. The supply of money, it decides the price. Price is a function of demand and supply of money. So if too much of money supply, price will go up. The very shortage of money supply, price will come down. Former is called inflation, the latter is called deflation. If there is no increase or decrease, it's called as stagflation. Okay, so the objective of RBI is growth with stability. Stability here means there should not be any price increase. Growth should be there, money supply should be there, but price should not rise. So that should be their objective. For that, it follows certain controls. Okay, they are called credit controls. They have some tools that's called qualitative and quantitative. These are all the tools available for credit control, qualitative as well as quantitative. Qualitative is also called a selective credit control. Okay, let's see them in detail, qualitative as well as quantitative. Qualitative tools. 1. Margin adjustments. Margin adjustments, rationing of credit, moral suasion, and direct action. So margin adjustments means, so suppose somebody buys a house in OMR for 1 crore, apply for a housing loan. The bank doesn't give 1 crore as a loan. It keeps a margin, say 10%, then it will give 90 lakhs loan. If it is increased to 20%, it will give 80 lakhs loan. If it is 30% margin, it will be 70 lakhs. So by increasing or decreasing the margin, it controls the amount of money supply going from the bank into the market. So by RBI stipulates that so much of margin should be maintained for such accounts. So by adjusting the margin, money supply is controlled. Then rationing of credit. There are different sectors of the economy, and RBI stipulates for agriculture so much of percentage loan should be given. For education, so much of percentage of loans should be given. For small scale industry, so much of percentage of loans are given. So by rationing of credit, RBI controls the money supply. Then moral suasion. It is not there is no regulation, rule or law, but RBI periodically controls meetings with chief executives of banks and advises them what is desirable for the economy. It's morally they persuade them, okay, give loans to priority sector, like that, education loans. So that is called moral suasion. Then direct action. RBI stipulates policy measures, and if the banks, they don't stick to that, if they don't implement them, then they take action. They impose penalty, they reject loans from the banks. So likewise, they take some direct action if they don't stick to the rules. So these are all called qualitative tools available, and there are quantitative tools also. Bank rate policy, bank rate policy, open market operations, CRR adjustment, SLR adjustment. Bank rate is the rate at which central bank lends money to the member banks. By increasing the rate, RBI makes the money costly. It is dear money. So consequently, the bank increases the interest rate for the customers. So the customers will take lesser amount of loan. If the interest rate is higher, they will take lesser amount of loan. If the interest rate is lower, they take higher amount of loan. So by adjusting the bank rate, because bank's lending rate is directly linked to this bank rate. So, by adjusting the bank rate, RBI controls the money getting into the market. Then OMO, open market operations. RBI buys and sells securities in the market, treasury bills, bonds, this kind of securities banks invest. So, if they invest in Reserve Bank of India sells these securities to banks, then the money is coming from the banks to the Reserve Bank of India. So, money at the disposal of the banks is less. So, the amount left with them to give us loans is less. So, money supply is curtailed at the bank level. If Reserve Bank of India buys these securities from banks, money supply goes from Reserve Bank of India to the banks. So, the banks are flush with money, they give more loans, money supply gets increased. So, by open market operations, money supply can be increased or decreased. So, essentially it is controlling of the money supply. That is why it is called quantitative. Then CRR adjustments. Banks are expected to maintain a certain percentage of demand and time liabilities as cash with Reserve Bank of India, that is CRR. By increasing or decreasing the CRR rates, the banks are forced to maintain cash at the Reserve Bank of India. So, the money at their disposal gets decreased. Okay, if the CRR rate is increased, the money at the disposal of the banks is decreased. So, the available cash for them to give us loans get diminished. So, money supply gets diminished. So, by adjusting CRR, money supply can be increased or decreased. Likewise, SLR, statutory liquidity ratio. Banks are expected to maintain a certain percentage of demand and time liabilities in approved securities. So, Reserve Bank of India fixes this rate SLR. By increasing or decreasing the SLR rate, banks are forced to increase or decrease the money, quantum of money at their disposal to give us loans. So, by increasing or decreasing the SLR, money at the disposal of the banks are increased or decreased. So, money supply getting into the market is increased or decreased. So, essentially all these are aimed at increasing or decreasing the money supply, because too much of money will increase in price rise. So, to avoid that, growth should be there, but at the same time stability, that means price stability should be there. So, RBI follows this in credit control function by qualitative and quantitative tools. For that they have these tools, and by using these tools they control the money supply, thereby control inflation. Okay, that is called a credit control. So, these are all some of the functions of Reserve Bank of India. Okay, so, we have seen Reserve Bank of India, their formation, their organization, their functions, and credit control function essentially. So, we will see more of this in our next session. Thank you for watching.